benefit. A lot to get through, a jam-packed session, and let's take a look at the presenters. I'm going to kick us off. I'm Mark Rogers, a principal in our Chicago office. I handle all things fixed asset services. We're going to go through a couple of our pillars. I'm going to hand it off to Joe Sawatsky. He's a senior manager out of Minneapolis. He'll be talking about energy incentives and really diving into 179D. And then Joe Stoddard, a partner in our Salt Lake City office, he'll be taking us home with R&D tax incentives. So again, thank you for joining. We have a lot to get through, so let's dig in. So at iBailey, we like to look at fixed asset services in 4 pillars, we call them: fixed asset planning, cost segregation, construction tax planning, and energy incentives. The common denominator being we find deductions in the built environment. So if they're out there and you can claim them, we assess and then analyze and realize it on the return. So let's start with fixed asset planning. This is a very wordy slide, so I'll let you read through it. But the point here about fixed asset planning is going above and beyond maybe your typical compliance and periodic additions into your software system, and really taking a fine-tooth comb, particularly to your building improvement, leasehold improvement, and land improvements, to try to maximize deductions that are out there. There's a lot of provisions out there that realize these deductions, and how do they work together in unison, and how can we grab these things using invoice techniques, engineering techniques, and proving out that deduction so that year in and year out you're maximizing fixed asset deductions that go along with your tax strategy. You're not missing out because it kind of slipped through the cracks. So that's fixed asset planning, kind of goes hand in hand with your tax planning strategy. And why do we do it? Really, it's an acceleration of deductions. Typically, besides waiting 39 years to capture a deduction, you get it all in year 1 or within years 1 through 5 or even years 1 through 15. We live in a world right now in bonus depreciation where you get it all in year 1, which is a very good thing. It reduces your tax liability, significant cash flow. The net present value of doing something like this is always 10 to 1 fee to benefit type of ratio. So it's really a no-brainer type of planning item if you're in the mood for deductions. Furthermore, we plan out so we can set up the framework of our fixed assets in such a manner that we can capture deductions in the future. I'm sure someone on the call who deal with fixed assets and are responsible for putting the software know that things can get pretty messy sometimes, looking back and trying to find maybe a partial disposition or reconcile certain numbers. That's what fixed planning does, is gets your books in a good place so you're always maximizing your deduction. And the beautiful thing about fixed asset planning, other than very nice deduction, is when you can do it. It's very flexible. So we can go back in time and retroactively claim deductions you might have missed out on in the past. The easiest way, of course, is just to catch it in the current year, make it part of your process, and seamlessly go on to the Form 4562. And there's even ways to be proactive in this space to make sure you're maximizing and getting involved during the design stage and the construction in progress. And we'll talk a little bit about that. So very flexible way to get deductions. So how do we do it? Really, it all starts with an assessment. So if you're not in a good rhythm with your fixed assets, it's more of just a compliance type of thing. You start with an assessment. We'll see what's out there. So just a couple, and I'll run through the bullets: recovery periods and bonus. So we now live in a world of 100% bonus. So anything that is lower than 20 years or less recovery period gets 100% bonus written off in 1 year. And that's going to go through 2022. And then it kind of goes down to 80%, 60%. And who knows what's going to happen past 2022 if they extend things. Section 179, another way for small taxpayers to grab deductions. Repair and maintenance one that's not used too often but should be. Just because you capitalize something for a book, say a roof, doesn't mean you have to capitalize it for tax. And there's methods that came out, tangible property regulations, that allow you to expense certain improvements that otherwise you wouldn't be able to capture, that have to stay at real property. And of course, cost segregation, been around forever, and we're going to talk a little bit about that for 1995 in its modern form, and just a way to chunk that building down and getting into those recovery periods for that 100% bonus. Partial dispositions, anyone who does renovations, remodeling, that's one that gets overlooked quite a bit, but it's an election that's made by doing it, but you have to do it. And we'll talk a little bit more about that too. Removal cost. You can expense demo cost in year one if and only if you take a partial disposition. So a nice 1-2 punch. And then Joe will be talking a little bit more later on about energy incentives and how those incentives interplay with all the bullets above. So when we do fixed asset planning, we're really looking at the building life holistically. So you're looking at a chart right now. It goes from 0 to 5 years, 5 to 15, 15 to 30, all the way through demolition. And in each quadrant are the provisions available for deductions. So what we see a lot that taxpayers doing is that green or forest green quadrant, the first quadrant, where if they're building something or acquiring a building, we do a lot of cost segregations. We see those come through. Where we're trying to get better at, and taxpayers in general, is after the building is built and renovations are coming through, remodels are coming through, to capture those benefits. There's significant benefits there. You might build a $1 million building and grab 20% of that into a deduction and get a nice $200,000 deduction. And then 10 years later, replace the roof. You might replace the roof for $200,000 and capitalize on your books, and just stays there. And if you were to take a closer look, you might find out that that roof can be expensed. So the same result, $200,000 deduction, but kind of getting overlooked throughout the life cycle. So that's what fixed asset planning is maximizing year in, year out, kind of the life cycle of the building to make sure you grab those deductions. Okay, and then cost segregation. So like I said, been around for a while, nothing new, but something that needs to be done every time you are building or doing a major renovation. So for tax purposes, you're able to segregate property into a lower life, building property. I'm not talking about furniture and fixtures and equipment, machinery, things like that. That's easy enough to grab, and hopefully everyone on this call is grabbing those into their shorter life. I'm talking about building components. For instance, a television set, we know to reclass to a 5 or 7 year, but did you know that we can grab the electrical to that television set? I'm talking about the conduit, the wiring in the walls, the outlet, all the way to the circuit breaker turning on and off the television set. So it's tricks like that and 100 more that kind of make up cost segregation. So there we're chunking as much 39 year into a 5, 7, or 15 year bucket, so you're realizing that 100% bonus. So cost seg needs to be done, has been around for a while, and here's the process. There's an audit technique guide to doing a cost seg. A lot of people do it, and as long as you follow the audit technique guide and follow the 13 principal elements of cost segregation, things should be copacetic. So this is the process, and you qualify, you gather the information, you do a site visit, you do engineering takeoffs, you price out those takeoffs, and hopefully at the end of the day you get a nice deduction. The whole purpose of the process is to prove the deduction. So the deduction's yours, but the burden of proving the deduction is on the taxpayer. So essentially the cost segregation analysis proves the large deduction that's being taken. Okay, so I threw this slide in here, and hopefully it's the last time I will have to throw this slide in there. Those who are in the know that there was a dream that qualified improvement property would be 15-year bonus. So anything interior that you're renovating, drywall, flooring, ceiling tile, would just get expensed in year one. Congress, when drafting the TCJA, made a mistake and made it 39-year property. We thought, for the past 2 years, we've thought that they were going to correct this because it was an oops, but they have not corrected this. So we are still at a point where qualified improvement property is at 39-year. So in case those who are wondering or keeping score at home, nothing new to report. If you have an interior renovation, we're still at that 39-year. We can obviously, you can chuck it down with cost segregation. You can look at repair and maintenance provisions. There are other ways to get it to 100% bonus or expense position. QIP is just not one of them. Okay, construction tax planning. This is a more proactive approach. So we see this a lot when we're trying to bridge accounting with the construction industry. Many times we hear about building and building improvements at the end, and we go ahead and have to book these fixed assets and put lives on them and try to scramble to maximize. In a construction tax planning setting, these are usually larger projects that are spanning a year or more, or multiple projects spanning many years for a campus or for other programs, where we go in and on a monthly or quarterly basis, periodically, look at what's coming in from the general contractor, look at what's coming from the architect, and grabbing those deductions in real time, getting them on the fixed asset ledger appropriately, and addressing any concerns. So the 4 stages, we assess as early as the design, periodically following up with memos and updated depreciation schedules and estimates, analyzing the construction costs in real time and giving advice on how it should be broken down. And of course, it's one thing to get a deduction, it's another thing to actually realize it on your fixed asset software properly. So let's go through some case studies, then we'll have a polling question, and then we'll get into 179D. So the first one here is a hospital case study. By the way, hospitals, wonderful industry for these type of deductions, because hospitals are always building, always renovating, remodeling, refreshing. We had a hospital come to us, said they are building a new hospital for $55 million. Can we do a cost segregation? We said, absolutely. Can we also look at your fixed asset ledger? We found that they had $8 million of, from a previous existing hospital, $8 million of existing renovations, remodels throughout a span of 10 years. And so while we're waiting on this $55 million project to be completed and do a study on, we went ahead and found them a $5 million deduction in the current tax year, just from repair and maintenance, partial disposition, and then some cost seg all combined into one. So a great answer right away. Senior living, my gosh, last 10 or 15 years, a ton of these have come online and the benefits are substantial. We do quite a bit. We have one client, taxpayer, who is building 2 to 3 of these each year. So we kind of get into a construction tax planning rhythm. They're roughly a $20 million spend. We're getting them 2 to 3 million, or I should say 4 to 6 million in bonus eligible stuff, bonus eligible deductions. Then a hotel case study. This is another construction tax planning where they're building 40 hotels in the next 3 years. So we set up some menu pricing and we speak straight to the general contractor. We get costs as they roll in, put them into the tool, and kind of maximize the deduction, so you're not missing out on anything. Hotels are another great industry because they're always doing similar type of renovations and building type work. Manufacturing, a lot going on in manufacturing, because when I say we try to chunk things into a 1245 personal property, it's mostly based on process. If you can say something is process related and tie it in with the process of the company, you can take it as a deduction. So, and manufacturing has a lot of that, a lot of exhaust type equipment, electrical connections, bus duct, a whole host of eye wash stations, a whole host of pits, concrete pits. So a lot going on there. So usually our percentages on there would be 40 to 50% of maybe the building components, getting that into a better 100% bonus place. So we had one where food manufacturer and distributor spent $35 million. We found 11 million right off the bat from building. I'm not talking about equipment. And we were able to give them an import file for software integration. So there's one thing to consider here, you know, these great deductions, but it's also the implementation of these things. So whether it's B&A or Sage FAS or NetSuite or CS, you have to deliver these in such a way so you could report them onto your eventually to your 4562. I think in this case, they were more happy about the import files, 300 line items, all well broken out, and they were with the actual deduction. So, and then banks, we do a lot of banks. Essentially, we do a lot of anything that's making money, but banks are always doing renovations and remodels and opening up new bank branches. This is one where we looked back at 10 years of fixed assets and found a $5 million catch-up deduction all in year one. So a nice benefit there. And the last one, a real estate case study, 44 property portfolio with some apartments, a little bit of commercial retail. We did a retroactive cost segregation on that. And to note here, those who are buying real estate, the TCGA allows for 100% bonus on qualified property for acquisitions. That wasn't the case before September 28th of 17. So a nice little perk for those who are in the real estate game who are acquiring property. All of a sudden, any qualified property that you find or chunk away from that building goes straight into 100% bonus. So it all starts with an assessment. If you haven't done an assessment or are coming out of NOLs and are in the mood for deductions, then it's time to take another peek at your fixed asset ledger. It should be part of your tax plan strategy and how to maximize that and get a process that's solid going forward. And that brings us to our first polling question.
What best describes your current approach to fixed asset planning this year? You do have 4 options there.
And really, for this, there's no wrong answer here. No reason to, if I see that a majority of people are saying a robust strategy, I'll know you're lying. Kind of like when we tell our dentist we floss all the time. Okay, great. So they're right along the lines of kind of what we see with our client base and taxpayers in general. It's an annual exercise in compliance. I think we're going to hand it off to Joe Sawatsky, and he's going to talk a little bit about the extension, the tax extenders in 179D.
Awesome. Joe, you have control if you'll click on the screen.
All right, fantastic. Thank you, Mark, and thank you all for joining us here. For the next 20 minutes or so, I'll talk about energy incentives, diving more deeply into 179D, but also touching on 45L as well. So we'll start out with a quick overview and history of the 2 programs, and then we'll dive into the program specifics for both 179D, as well as a couple case studies for both 45L and 179D. Let's get started. So just a brief history lesson here, not to bore anyone with the details, but both 179D and 45L were both enacted via the Energy Policy Act of 2005. And both of these programs are commonly known as extenders. And so it's one of these situations where Congress enacts them and has them sunset or expire in 2 or 3 years. And inevitably they are renewed. And you can see at the bottom there, we had our most recent renewal, Tax Extender and Relief Act of 2019. And that came online right before Christmas, December 20th. And so we are now 7 for 7 in terms of renewals, expirations, and renewals. The good news is in the most recent extension, they retroactively extended both programs to go back to 2018. So no gap there in coverage, and then extended it through 19 and then through calendar year 2020. So let's start with 179D, Energy Efficient Commercial Building Property Tax Act deduction. And what 179D is it's a deduction of up to $1.80 per square foot. As I mentioned before, extended through 2020, and we're going to kind of branch into 2 phases here as we talk about 179D. We're going to talk about privately owned buildings, and then we're also going to talk about government or publicly owned buildings. The good news on privately owned buildings, similar to a cost seg study, you can go all the way back to any property placed in service in 2006, and the deduction is taken by a 3115 and a 41A adjustment. On the governmental side, which we'll dig deeper into in a moment, that is limited to open tax years, and amended returns would be required to go back in time. So the qualification requirements on the 179D. So at the end of the day, the Department of Energy and the IRS kind of teamed up and wanted to create an incentive for folks and building owners to go green. And so to do that, they said, all right, if you are able to build a building and that building is 50% more efficient than the ASHRAE 90.1 standard, and that varies between the 2001, 2007, depending on when the project was placed in service. But if you're able to demonstrate these energy efficiencies, you're entitled to a deduction. And so the savings are split into three components. First one's building envelope, so think walls, windows, roof, things of that nature. And we have HVAC and hot water. And the third component is interior lighting. And each one of these three deductions is worth 60 cents a piece for a total of $1.80. So let's start and talk a little bit more how this Section 179D deduction pertains to building owners. Mark mentioned kind of mining the build environment for deductions, and this is just another example or kind of another lever that you can pull for those folks who are interested in maximizing their deductions. So we'll start with just a very brief case study. This was a heavy equipment dealership in the Pacific Northwest. There you can see kind of the energy efficient features of the building. But at the end of the day, the important thing to note here is the entire building, 149,000 foot, qualified for the full $1.80 deduction, which yielded the owner about a $269,000 deduction. As I mentioned before, claiming the deduction is quite simple on the private side. In the current year, just goes in on the other deductions line with an attachment, and then just a 179D deduction. And then in prior years, like I mentioned, you can go all the way back to 2005 using a 3115, and then a quick 481A calc to square up the deduction. So some triggers that we look for, and oftentimes on the private side, these 179D deductions are done in conjunction with a cost seg study. Typically, the cost segregation studies are more compelling in terms of the return on investment, but we kind of like to think of it as the icing on the cake. If we're looking to maximize the deductions, like I said, it's just another lever we can pull. Because the deduction is on a per square foot basis, typically, there's no hard and fast rule on this, but typically we see that 25,000 square foot building is kind of the threshold where the numbers get interesting enough and compelling enough to move forward with the study, or at least look for, or at least create the assessment and see if the numbers make sense. Again, we can go all the way back to 2006 and through the calendar year 2020. And then obviously just another way to maximize our deductions. So we'll take us to that second polling question here.
All right, the second polling question. Have you constructed or renovated a building greater than 25,000 square feet in the last 10 years?
Okay, wow, almost 30%. That's great. All right, let's keep moving here. So we talked about 179D as it pertains to privately owned buildings. And what I want to spend a little bit more time on today is talk about 179D as it pertains to government-owned buildings for the quote-unquote designers of the buildings. And so quick overview here is governmental buildings, so think schools, courthouses, really any government-owned building. And those entities don't pay taxes, at least in the traditional sense. And so $1.80 per square foot deduction isn't very compelling to them. And so there's a provision in the code that allows these governmental entities to assign the deduction to the quote unquote designer, which we'll dig into it in a minute. And so in this case, if you design and build energy efficient real estate for governmental entities, you, the designer, are now eligible for this for the full $1.80 or up to $1.80 deduction. So here you can see a pretty representative example. This was a theater in the Midwest here. You can see about an 80,000 foot building. This one easily qualified or met that 50% energy efficiency threshold. And that netted, in this case, the architect a $143,000 deduction. That's pretty typical. Here we can see some additional examples of just representative results of different property types and deduction scenarios. You'll notice there the fourth row down, we look at student housing. Student housing is a great candidate, dormitories and the like. There we just need to be a little bit careful. They need to be 4 stories or more above grade in order to qualify for 179D. You'll also notice about 2/3 of the way down a parking garage. Parking garage isn't conditioned space, obviously, but in those cases, you are able to take advantage of the lighting component, or 60 cent, up to a 60-cent deduction on the lighting. And so this, on the governmental side for these designers, is a really great tax planning opportunity for you and your CPA to kind of come together and look at, you know, our taxable income for the year and really dig into and say, all right, where are our options here? What governmental buildings have we worked on? What are some deduction scenarios? And that's obviously something that I help with every day. And then just to kind of put those numbers together and see what it looks like for you as you move through the process. So what we do here at Eide Bailly, and I think a number of firms probably do something similar, for folks who are just kind of getting into 179D on the governmental side, or maybe have heard of it, or, you know, just tipping their toe into the water, we take a 4-step process, and it's very much along the lines of just kind of an educational situation. So as we move through the process, everyone feels comfortable and knows, you know, knows the expected outcome before we start. So the first step that we look at is we take a look and we think about, all right, can we find a client or potential client that meets these following criteria, right? So obviously this is another deduction situation. So we're looking for for-profit tax-paying entities. The firm type, quote unquote designer, which we'll talk about in a minute. Obviously the big hitters in there are architects, engineers. And then it also covers general contractors and subcontractors who work on these different building components. We need to be a little bit careful on their scope of work to make sure that we meet the designer status. Not something to be scared away from, but something to consider. And then, of course, because this is for governmental owned buildings, look at kind of their client base and what projects they are working on for whom. Once we identify firms that might be able to benefit, the next step is to take a look and have a conversation with the stakeholders and kind of have an overview of the 179D program, similar to what we're doing here now. And then again, kind of forecast out the ideal deduction scenario, taxable income to shelter, the ownership basis, and then take a look at the typical work with governmental entities, specifically around that designer status. Let's talk a little bit more about that right now. So who is a designer? And there are a number of words on this slide which you can read, but at the end of the day, a designer is the person or the company who creates the technical specifications for the energy efficient property. So one of the 3 components. So if you design the tech specs for the building envelope, any one of those building envelope components that I mentioned, the interior lighting systems, or the mechanical, HVAC and hot water, then you are considered the designer. You'll see at the bottom there, a person that merely installs, repairs, or maintains the property is not a designer. And so a quintessential example of someone that would not meet that criteria might be a roofing contractor. And so we think about maybe a 100,000 square foot school that's putting on a new roof. And the architect draws up the plans, and maybe there's an engineer that helps with the specs, and they engage a local subcontractor to remove the existing EPDM membrane. Maybe they put down some additional insulation and put on a new roof. And in doing that, makes the school energy efficient such that it qualifies for the deduction. In this case, because the subcontractor, the roofing contractor, didn't play any role in designing the technical specifications of the roof. They just kind of came in, demoed what they needed to, and put on the new EPDM as designed. In this case, the contractor would not be eligible for the 179D deduction. In that case, it would be more appropriate for either the architect or the engineer to take advantage of the 179D. Once we've met those hurdles, what we like to do is kind of flesh out the deduction scenarios. And there you can kind of see an opportunity listing forecast sheet that we use. And we look for non-residential buildings. Again, residential buildings, as long as they are 4 stories and above. New constructions obviously are great candidates, as well as renovations and additions. Renovations, we take a look at kind of a case-by-case situation, depending on the scope of work, what was existing prior to the renovation, to see what the expected qualification levels are. Because it's an open tax year on the governmental side, typically, although we're kind of getting up to it now, typically we're looking at projects placed in service in 2018, 19, and anything expected to be placed in service here in 20. Project cost, approximate footage of 45,000 and 25,000. Those aren't hard and fast rules, but again, because the deduction is on a per square foot basis and is limited by the project cost, we need to have big enough numbers in there for it to be interesting for folks to move forward. Once we have it all scoped out and looks like a viable candidate, or looks like we're going to move forward with the engagement, the next step obviously is the engagement letter, and then we get into the project. We aggregate the plans and specs and the allocation letters, which we'll talk about in a second. A site visit is always required by law, as well as energy modeling using Department of Energy and IRS approved softwares. And then a certification by a qualified individual is always required as well. Qualified individual is a licensed contractor or professional engineer, unrelated, who actually certifies and can sign off on these. Let's take a look at an allocation letter. So here is an example of an allocation letter. There is no standardized form of the layout of this letter, but the information contained on here is very important, and you need all of these pieces of information, and the verbiage needs to be such that it is laid out in this way. And so there you can see, and what this allocation letter is, for those who aren't familiar, this is the mechanism by which the governmental entities assigns the deduction of up to $1.80 per square foot to the quote-unquote designer. So let's just walk through this very quickly. For section 1 there, you can see the authorized governmental representative information, name, address, telephone. There is no bright line test as to who at the governmental entity is an authorized representative. It's the person who has familiarity with the building and the project and can verify things such as placed in service date, cost of property, square footage, things of that nature. As long as we're making a good best case or a best effort to reach out to the appropriate person at the governmental entity, like I said, there's no title that he or she needs to have. Designer information, that is the folks who are going to be taking advantage of the deduction. Building address, as you can see there. Cost of the property, placed in service, and that's important because we're looking at, typically on the governmental side now, we're looking for projects placed in service in 18, 19, and 20. Section 6 there, the amount of the deduction allocated to the designer. It is at the governmental entity's sole discretion as to who they allocate this deduction to. From a practical matter on smaller projects, it's typically a first come, first served situation. So there may be an architect and an engineer who can both rightfully claim designer status. And usually it's whoever contacts the governmental entity first to get this allocation letter signed. And so what we've been counseling our clients is when they are beginning a project, and even at contract stage when they're having the contract docs signed, is to go ahead and include this allocation letter in with those contract docs. And what that'll ensure is make sure that you're at the front of the line to make sure that you are able to take advantage of the deduction. Signature of the designer, that's the representative of the client, and you can see section 8 there, declared by the authorized representative of the governmentally owned property. And you can see that under penalties of perjury language there, that is required, and then he or she signs and dates. So triggers, whether you're working with clients or maybe you are a client, we're looking for quote unquote, again, the designers working with governmental entities. Projects, again, placed in service in an open tax year, typically 2018, 2020. And because this is another opportunity for deductions, it's something that we're looking for. So from a holistic view, key takeaways on 179D, it's up to $1.80 per square foot deduction. Deduction is 3 components, each worth 60 cents a piece. On privately owned buildings, you can go all the way back to January 1st, 2006 through a 3115 481A adjustment. Governmental side, again, you're limited to open tax years and placed in service through the end of this year. And again, because the program is on a per square foot basis, the deduction is on a per square foot basis. Typically, 25,000 feet and above is where things get interesting. Certainly not a requirement, but a good fact pattern to start with. Let's close the loop on that and talk briefly about Section 45L. And this is the Energy Efficiency Home Tax Credit. So dissimilar to 179D, 45L is specific to residential real estate, 3 stories and less. And as opposed to on a per square foot basis, this is on a per dwelling unit, so apartment unit or per home unit. Qualifies for a $2,000 per unit credit, not deduction, but credit for qualifying real estate. So let's take a quick look at an example here. This is a 52 unit town home complex. This is out in the Pacific Northwest, I believe. And there you can see the energy efficient features of the complex. And in this case, 100% of the units passed and qualified for 45L, which yielded not a deduction, but a credit of $104,000 for the owner. So similar to 179D, there are qualification requirements. They're different, but it's a variation on the theme. You must demonstrate a 50% or greater energy efficiency over reference unit. And in this case, it's based on the International Energy Conservation Code, or IECC, of 2006. Building envelope must count for 10% or 1/5 of the overall energy savings. And I will throw out there, although it doesn't come up often, manufactured homes are also qualify. Now they'll qualify for a $1,000 per unit credit, but the energy efficiency threshold there is only 30%. Some positive factors here, look at opportunities, certainly no guarantees, but HVAC efficiency, obviously attic insulation up here in Minneapolis is a huge deal, as well as the windows. Those are big components that we certainly look at as we scope out these projects. Claiming the credit is relatively straightforward, using Form 8908. Current year, taken on the current year, and on previous tax years, similar on the governmental entity side for 179D, requires amended returns. So you're typically limited to, again, 18, 19, and 20 for those projects. So the key takeaways on 45L, we're $2,000 per unit. Now we must be 3 stories or less above grade, not including an underground parking garage, but that's very important. If you fall into that residential high-rise residential, then you'll be flipped into the 179D, that $1.80 per square foot deduction. So this is specific to 3 stories and less. Also, dissimilar to 179D, it's not based on placed in service date. 45L is on occupancy date, so the date that the unit was originally leased up or sold. And we typically kind of look for 10 units or above, just to kind of make those numbers compelling enough to move forward. And then plans and specs are required for provisional analysis. And so what we'll do there on the 45L side, because it is a slightly higher standard than what we see on 179D, is what we'll do is if there's a client or someone who's interested in taking a look at 45L, what we'll do is we'll obtain the engagement, and then we'll take a look at the plans and specs and run the provisional analyses using the approved software. And we'll say, all right, based on the information to date, we think that either this project hopefully will qualify, but if there are deficiencies in there, we'll create a memorandum that outlines where the deficient areas are and possibly some areas that could be improved or remediated for the project. hopefully we'll get in there early enough, and Mark talked about the construction tax plan. If we're able to get in there early enough in the design phase, we're able to give some guidance. And so it would be, and we've seen this happen, and it's a shame if the building envelope doesn't qualify, for instance, because the R value on the walls. If we would have just bumped up that R value maybe 2 or 3 by 2 or 3, then we would qualify for the 45L. Once the drywall goes up and the furniture's moved in, obviously that's not practical. But if we're able to get in there early enough before the insulation and drywall is installed, then maybe it's a business decision where the marginal increase in cost of the additional insulation might be compelling enough to actually move forward. And with that, I will turn it over to Mr. Joe Stoddard, who will take us home with research and development tax incentives.
Awesome. Thank you, Joe. I guess as we transition, there was a really good question that came out circling back to 179D. So if you wouldn't mind staying unmuted for a minute, Joe. It says, are governmental agencies favorably inclined to assist designers with this tax benefit? Seems counterintuitive to the feds, for example, to help me reduce my tax burden. So what are your thoughts on that? Yeah,
that's a great question. So the allocation letter, there is no requirement that the governmental entities sign off on these allocation letters and assign the deduction to the designers. Really, the program is designed to promote energy efficient design, right? So the benefit to the governmental entities on these is, they'll have reduced energy costs and maybe a more conducive, conductive learning environment for the kids in the schools. And so usually we have pretty good success. Sometimes there's some education that's required with these governmental entity folks who maybe don't fully understand exactly what 179D is and their involvement, why it's important. But typically with a conversation or an email, usually it's a non-issue and we're able to move forward. There are exceptions here or there, but usually once everyone's on board, it's a pretty easy conversation, and we're all able to work together to move forward on that.
Awesome, thanks, Joe. Yeah, so this is Joe Stoddard now. We're going to finish this up talking about R&D incentives. Kind of the purpose of this webcast is to look at several different levers that you can potentially pull as you're doing your tax planning. Certainly, probably the broadest opportunity that we've talked about is just around the fixed asset world, right? Of fixed asset planning, cost segregation. As long as you have real property, those are tax planning tools that you can use to reduce your tax burden. Some of the more narrow provisions around 179D and 45L can be very lucrative if we're in the right fact pattern there. And R&D is similar. It can be fairly broad, which we'll talk about here in a minute, but can also be a very nice tool, nice lever that you can pull with your tax planning. So wanted to talk through that. My comments are geared both towards those companies that have been claiming a credit. So we're going to talk about some recent developments and things that are on the horizon that you want to be aware of, but also wanted to give an overview of the R&D tax credit for those who aren't as familiar with it, and maybe give you some idea whether or not you or your company might be able to qualify. So, first slide, just trying to give an overview about the credit. The range of the benefit, it's an incremental credit. So the amount of credit you claim in a given tax year, so say 2020, is affected by historical R&D spend. So it's a little bit like most things in the tax code, a little bit convoluted in how we come up with the actual credit amount. But the range we typically see is between 5 or 6% and 8% on the dollar. So if we can identify $100,000 of expenses, that would typically equate to maybe a $6,000 to $8,000 tax credit. And that's a dollar for dollar credit. So if you typically can reduce your liability by that same amount. And we'll talk through those activities and what those expenses would be here as we go on. Most states also offer some type of R&D incentive. A lot of the states that don't offer an R&D incentive is because they may not have, an income tax. So, kind of looking at the Bailey footprint, the states that we don't work with would be states like Nevada, South Dakota that don't have an income tax. But most states that have an income tax have a credit as well. For example, my home state of Utah, the Utah credit is often bigger than the federal credit. So if you're in one of those states that has a nice credit, you can essentially double dip and get credits for both federal and state level. I'll dive into the payroll tax offset later, so I'll skip over that bullet point for now. And for those companies that have not claimed an R&D credit before or haven't done an R&D study to kind of take a deeper dive, we're looking at both the current year, but we can also go back and amend prior tax years to claim the credit. Typically we can go back at least 3 years and amend those returns. And then if you're not able to utilize all the credits that are identified, they do carry forward. So there's a 20-year carry forward on the federal credit to hopefully be able to use that over time. So in terms of the types of activities, let's start there. Again, I've alluded to this earlier, but there's a fairly broad definition of R&D. You know, a lot of people who aren't familiar with the credit, they hear the term R&D tax credit, and in their mind, you know, someone is doing R&D when they have a white lab coat on and they're dealing with, you know, working with Bunsen burners and test beakers and that sort of a thing. And certainly that type of R&D can qualify, but it's much broader than that. Industry-wise, I think the majority of our clients that are claiming the R&D credit are in the manufacturing industry. We also work with a lot of companies, obviously in technology, so software, but also hardware companies, life sciences, some companies even in the construction space. I'd say the most common type of company to qualify in that space would be an engineering firm. So a lot of times there's an opportunity to benefit from both R&D, but also 179D deductions can also be beneficial there. So again, fairly broad definition. R&D can relate to, you know, the term from the tax code is business components. So we need to identify the qualifying activities at the business component level and then allocate the cost at that same level. So, you know, that in layman's terms, we're looking at new or improved products, new or improved processes, software, techniques, formulas, inventions, etc. So fairly broad, the types of business components that can qualify. The most common things we deal with are, again, products, manufacturing process development improvement, software development, software enhancement. Those are the most common areas we look at. There's a 4-part test. Because of the time, we're going to kind of skip over this slide. But one thing we need to kind of look at is the activities do have to be technological in nature, that 4th test here. So one question we commonly get is, hey, I'm working to, you said that process improvement can qualify. I'm working to improve my business processes. Is that an area we can claim for the credit? Typically the answer is no, because it has to be more technological in nature. Unless you're developing software or using other technology to do that, then maybe we can qualify that part of the activity. And again, I'm not going to run through all of these examples. I've sort of talked through some of these already, but here's some of, and this is not an exhaustive list, but just a few examples of areas that we work with to qualify different types of activities. And again, lots of different industries. One I didn't mention earlier, the picture here reminded me, we do also some work in the ag space and for different improvements that are being made, both on the crop side to improve yield, but also on the animal side from some genetic development or other things like that. So certainly certain opportunity there as well. Of course, equipment is a big part of the ag space as well. All right, we come to our 3rd polling question. Has your company ever claimed the federal and/or state R&D tax credits before? Kind of all over the map. Okay, again, we're running up to the hour, so I'll kind of skip through some of this information. The types of costs we can include, wages is the biggest component for the credit. Typically, we can also include some supplies. That can include prototypes, even if those prototypes are sold to the customer or placed in service. So some flexibility there. If you outsource the development, some of that can also qualify. One caveat, the activities do have to happen in the US. So one thing we often see is if companies that are maybe undertaking software development, for example, and some of that is contracted out to a 3rd party, we just need to ensure that the activities happen in the US. but those are kind of the statutorily defined buckets of costs we can include. I do want to touch on the payroll offset. This is a fairly new provision. For the longest time, we had the R&D credit, but brand new startups often aren't taxable. So they don't want to spend time and money to identify and document a credit if they're not going to get the benefit until the future. So this provision allows certain types of startup companies to elect to use the credit to offset payroll taxes instead of income tax. So as long as you have employees, you're paying payroll taxes, or hopefully you are. And in those cases, that can be a real benefit. So if you're kind of in that, if you're a startup company and doing R&D, we can certainly have an offline conversation to see if you can use that as a payroll tax offset. I did want to touch on tax reform and the impact on R&D credits. The short answer is, the R&D credit was retained as part of tax reform. The net benefit from the credit can be increased because of tax reform indirectly, and that's because the credit is either added back to your income or you elect a reduced credit. That reduced credit is based on the top corporate rate. So since the top corporate rate went down from 35% to 21%, either that add back amount is reduced or the reduced credit is reduced less. So you end up with more cash in your pocket. And then I did want to touch on, this was not a policy driven thing, but at the 11th hour, when they were working to pass tax reform, they were trying to find ways to pay for at least part of the corporate rate deduction. So one of the things that was thrown in at the end was this provision that kicks in tax year 2022 that would require all R&D expenses to be capitalized and amortized instead of expensed currently. So we'll see. There's been a lot of talk as we get closer and closer to this effective date. There's bipartisan support to either eliminate this provision or to kick it down the road a little bit so it won't take effect. Maybe it becomes one of the quote unquote extender items that gets extended every year or two. But this is a big deal, especially for companies that are R&D intensive. If you're looking at your effective tax rate and that sort of a thing, if you're not allowed to take your R&D costs in year one, but have to amortize that over 5 years for domestic or 15 years for foreign, that can be a big hit. So more to come on this. My personal thought is they're going to do something, and if I were a betting man, I don't have the crystal ball, but I'd say that the likelihood is it becomes sort of an extender and they delay the implementation date a couple of years is what I'm thinking. I want to make sure we get to our last polling question before we hit the top of the hour. So Amy, let's do this one as well.
Okay, sounds good. The fourth polling question is now open and it is a true or false.
More of you got it right than wrong. So it is false. The credit is still available. It's just that provision that requires the R&D cost to be capitalized and amortized does kick in unless that gets changed. All right, just a few comments as we wrap up. We have a couple of case studies in here. I won't go into details, but it kind of demonstrates the types of companies we've been able to help out. Just a representative sample. There's obviously lots more than that. We often get questions about how the IRS, and this is a subjective area of the tax law. We typically see the IRS is fairly aggressive. Most recently, we've seen IRS audits dragging on longer and longer, just with the IRS kind of budget situation and their resources. It can be super frustrating. Just these audits get started, and then we've had several examples, and we're in the middle of an audit, and an agent retires and has to be reassigned, which takes another several months. So it can be a frustrating exercise. But the reason we put together an R&D tax credit study is to put together the support, the substantiation, so that if you claim the credit, you can, if you get audited, you have that support in place. And we kind of take a phased approach. So of course, we'd love to, if you're interested in claiming a credit, we can talk about this offline, but we can do some upfront feasibility and scoping, really no charge for that. And then if there's an opportunity, similar to what Mark and Joe talked about, if there's an opportunity, we can make sure that the cost benefit makes sense. Again, I know we kind of ran up to the end of the time, so our contact info is here. Feel free to reach out directly to us with any questions. I'm happy to stick around for another couple minutes if anyone does have questions we can address here, but that's the end of our formal presentation. Thank you all for attending the webcast. Really appreciate it. Amy, I'll throw it back to you.
Awesome. Thank you all so much for attending, and thank you to our presenters. And we hope that everyone has a great day.